The current ratio is a financial metric that provides insight into a company's short-term liquidity. It measures a company's ability to pay its short-term obligations, which are debts and liabilities due within a year. These obligations are due within 1 year, making the current ratio a crucial indicator of financial health. Think of it as a snapshot of a company's financial health at a specific point in time. It helps stakeholders understand if the company can meet its short-term liabilities with its short-term assets. The current ratio focuses on two key components: current assets and current liabilities. Current assets are resources a company expects to convert into cash within a year. Current assets include cash, accounts receivable, and inventory. These are the most liquid assets, meaning they can be quickly converted into cash. Examples include cash, accounts receivable, and inventory. Cash is the most liquid asset, followed by accounts receivable, which are payments owed to the company by its customers, and inventory, which consists of goods available for sale. Current liabilities, on the other hand, are debts a company needs to pay within the same time frame. These include accounts payable, short-term loans, and accrued expenses. Common examples are accounts payable, short-term loans, and accrued expenses. Accounts payable are amounts a company owes to its suppliers, short-term loans are borrowings that need to be repaid within a year, and accrued expenses are costs that have been incurred but not yet paid. In essence, the current ratio assesses whether a company has enough readily available assets to cover its short-term debts. A higher current ratio indicates a stronger liquidity position, meaning the company is more capable of paying off its short-term obligations. Conversely, a lower current ratio may signal potential liquidity issues, suggesting the company might struggle to meet its short-term liabilities. To calculate the current ratio, you divide the company's current assets by its current liabilities. For example, if a company has $500,000 in current assets and $250,000 in current liabilities, its current ratio would be 2. This means the company has twice as many current assets as it does current liabilities, indicating a strong liquidity position. It's important to note that while a higher current ratio generally indicates better liquidity, an excessively high ratio might suggest that the company is not efficiently using its assets. Therefore, it's crucial to analyze the current ratio in the context of the industry and the company's overall financial strategy. In summary, the current ratio is a vital financial metric that helps assess a company's ability to meet its short-term obligations. By understanding and analyzing this ratio, stakeholders can make more informed decisions about the company's financial health and operational efficiency. Calculating the current ratio is straightforward. This ratio is a key indicator of a company's ability to meet its short-term obligations with its short-term assets. It's a fundamental metric used by financial analysts and investors to gauge liquidity. To calculate it, you simply divide the total value of current assets by the total value of current liabilities. Current assets include cash, inventory, and receivables, while current liabilities encompass debts and obligations due within a year. The formula is current ratio equals current assets divided by current liabilities. This straightforward equation can reveal a lot about a company's financial health. Let's illustrate with an example. Consider a company with $200,000 in current assets and $100,000 in current liabilities. In this scenario, the current ratio would be 2. This is because 200,000 divided by 100,000 equals 2. A current ratio of 2 means the company has twice as many current assets as it does current liabilities. This simple calculation provides valuable insights into a company's short-term financial stability. A higher current ratio indicates a stronger liquidity position, suggesting the company can easily cover its short-term obligations. Conversely, a lower current ratio might signal potential liquidity issues, meaning the company could struggle to meet its short-term debts. Therefore, understanding and calculating the current ratio is crucial for making informed financial decisions and assessing a company's financial health. A current ratio of 1 indicates that a company has exactly enough current assets to cover its current liabilities. A ratio above 1 suggests a stronger position, indicating more assets than liabilities. Conversely, a ratio below 1 raises concerns. It implies that a company may struggle to meet its short-term obligations. Generally, a current ratio between 1.5 and 2 is considered healthy. However, the ideal range can vary depending on the industry and specific business model. The current ratio is crucial for assessing liquidity. Liquidity refers to a company's ability to meet its short-term financial obligations as they come due. A healthy current ratio indicates good liquidity. This means a company can pay its bills on time, manage its working capital effectively, and seize growth opportunities. Conversely, a low current ratio signals potential liquidity problems. This can lead to missed payments, strained relationships with suppliers, and even bankruptcy. Section 5. Industry Insights. Comparing apples and oranges. While the current ratio offers valuable insights, it's essential to consider industry differences. Different industries have different operating cycles and capital requirements. For example, a grocery store with high inventory turnover might have a lower current ratio than a manufacturing company with a longer production cycle. Comparing current ratios across industries requires caution. Benchmarking against industry averages provides a more meaningful assessment. Section 6. Beyond the ratio. Limitations and considerations. While valuable, the current ratio has limitations. It provides a snapshot in time and doesn't reflect future cash flows or changes in business conditions. The quality of current assets also matters. A company with a high current ratio but slow-moving inventory might still face liquidity issues. Furthermore, the current ratio doesn't account for off-balance sheet items or potential contingent liabilities. It's essential to consider these factors for a comprehensive analysis. Section 7. A broader perspective. Comparing liquidity ratios. The current ratio is one of several liquidity ratios. Other commonly used ratios include the quick ratio, or acid test ratio, and the cash ratio. The quick ratio excludes inventory from current assets, providing a more conservative measure of liquidity. The cash ratio, the most stringent measure, considers only cash and cash equivalents. Using these ratios together provides a more nuanced understanding of a company's liquidity position. Section 8. Real-world applications, from business to Wall Street. The current ratio has numerous practical applications. Businesses use it to monitor their own liquidity, identify potential problems, and make informed financial decisions. Investors use the current ratio to assess the financial health of potential investments. A strong current ratio can indicate a lower risk of financial distress. Lenders use the current ratio to evaluate creditworthiness. A company with a healthy current ratio is more likely to repay its debts on time. Section 9. The big picture, using the current ratio wisely. The current ratio is a valuable tool for understanding a company's short-term financial health. It measures a company's ability to pay off its short-term liabilities with its short-term assets. This ratio is calculated by dividing current assets by current liabilities. It provides insights into liquidity, creditworthiness, and operational efficiency. A higher current ratio indicates that a company is more capable of paying its obligations, which can be reassuring to investors and creditors. However, it's crucial to remember that the current ratio is just one piece of the puzzle. While it offers a snapshot of financial health, it doesn't tell the whole story. For instance, a very high current ratio might suggest that a company is not using its assets efficiently. Use it in conjunction with other financial ratios, industry benchmarks, and qualitative factors for a comprehensive analysis. Ratios like the quick ratio, debt-to-equity ratio, and return on equity can provide additional layers of insight. Industry benchmarks help in comparing a company's performance against its peers. By understanding the current ratio and its limitations, investors and business owners can make more informed decisions. They can better assess the financial stability and operational efficiency of a company, leading to smarter investment choices and strategic business planning. Always consider the broader financial context and the specific industry dynamics when evaluating the current ratio.